Well, across the nation, economists and accountants have been speculating how the new federal tax plan will affect different states.
That's right, Byron. And today, Maryland released one of the first official analysis of how the new law will impact state taxpayers and future revenues.
Patricia Villone is just back from Annapolis with the details. Patricia?
And I can say this was probably one of the most complex stories I've ever had to cover here.
Wow.
So, for the last month, we have been hearing from concerned politicians about the potential impact of the new federal tax plan. Meanwhile, state accountants have been critically analyzing hundreds of thousands of tax returns to determine the potential outcome on state and local coffers.
To our knowledge, nothing like this has been prepared and published by any other state.
Comptroller Peter Franchot says his office conducted a computer analysis of all of last year's tax returns for Maryland residents to determine the potential pros and cons of the new federal tax plan. At first glance, it seems that 71% of Marylanders will see a tax benefit, a total of $3.6 billion to be exact. But Franchot says the long-term impact is harder to measure.
If future generations of taxpayers in Maryland are going to be left with a hefty bill thanks to the $1 trillion plus of deficit additions that are going to flow from this analysis.
Among the largest benefits to taxpayers is the doubling of the federal child tax credit from $1,000 to $2,000 per child. The change is expected to affect 633,000 Marylanders. Another benefit, those who contribute to a 529 education plan can now include tuition expenses for K-12, public, private, or religious schools. In the past, the plan could only be used for higher education expenses.
Essentially what that means is you can use a 529 plan now to pay for private school. It increases a taxpayer's benefit significantly.
But the scaling back of almost all itemized deductions and the $10,000 cap on the state and local tax deduction could have a significant impact on many residents. The director of the Bureau of Revenue Estimates says because of the cap, Marylanders should consider deducting their property taxes before state and local taxes.
The federal return, you may be looking at a significant tax increase because of your loss of state and local income taxes, as well as the amount over the $10,000 on your real estate taxes.
So is your advice to actually do real estate taxes first before the other?
My advice is to talk to an accountant, but that is what I will be doing. I will be prioritizing $10,000 in real estate taxes first on my tax return.
The new law is also expected to sharply reduce the number of residents who qualify for the charitable tax deduction, a change nonprofits are worried about.
Charitable organizations who do so much, frankly, for the communities of our great state. These charitable organizations are going to find it much more difficult to raise funds for critical programs due to the changes in the standard deduction that reduces tax incentives for charitable giving.
Overall, the changes are expected to ease filing for many taxpayers, which Franchot says could improve compliance in the long run. Now, one thing the Comptroller's office wants taxpayers to know, if you take the standard deduction of $24,000 on your federal return, you must also take Maryland's standard $4,000 reduction.
Thanks for that report, Patty. Did they release a breakdown analysis by jurisdiction?
They say they have not released that yet, but they do expect to do something like that this weekend, by this weekend.
Okay. We'll look forward to that. Thank you.